index investing, if everybody did it, won't work. But for another considerable period, index investing is going to work better than active stock picking, where you try and know a lot.
Demonstrate so dramatically. I've talked to huge pension funds, and I've taken them through the math, and when I leave, they go out and hire a bunch of consultants and pay them a lot of money. And it's just unbelievable. And the consultants always change the recommendations a little bit from year to year. They can't change them 100% because then it didn't look like they knew what they were doing the year before. So they tweak them from year to year, and they come in and they have lots of charts and PowerPoint presentations, and they recommend people who in turn are going to charge them a lot of money, and they say, well, you can only get the best talent by paying 2 and 20 or something of the sort. And the flow of money from the hyperactive to what I call the helpers is dramatic. Well, this group over here sits here and absolutely gets the record of American industry. So I hope you'll realize that for the population as a whole, American business has done wonderfully, and the net result of hiring professional management, is a huge minus. And at the bookstore, we have a little book called Where Are the Customer's Yachts, written by Fred Schwitt. I read it when I was about 10 years old. Been updated it hadn't been updated, but new editions have been put out a few times, but the basic lessons are there. That lesson is told in that book from 1940. It's so obvious, and yet all the commercial push is behind telling you that you've got to think about doing something today that's different than you did yesterday. You don't have to do that. You just have to sit back and let American industry do its job for you. Charlie, do you have anything?
Well, I wrote a memo about 6 or 7 years ago entitled Investing Without People. And I talked about index and passive, systematic and algorithmic, AI and machine learning. And, when I went to Chicago, the professor told us that the statistics showed that most equity mutual funds did not equal the S&P before fees, and the vast majority lagged after fees. He says, why don't they just buy one share of every stock in the S&P? There was no such thing as index funds at that time, or indexation. And of course, Jack Bogle popularized it in '74. And now I believe that passive and index investing accounts for the majority of mutual fund equity capital. Not because passive results are so good, but because active was so bad. And so, if you go back to when we started, you could go into this business, you could hang up your signal, you could manage equity money, you could lag the S&P, and you could charge a high fee. The world's a smarter place now, and you can't do that. And that's why the money has flowed into passive funds. And by definition, on average, most people do average, and most people don't beat the average, which means they don't deserve high fees before fees, and they fall further behind after fees. So that was a flawed business model, which is in the process of being corrected. And that's why a lot of money has been turned over to, let's say, machines, something mechanical. And I still believe that there are people who have superior insight and see things better. And, the future is not a fact. The future does not yet exist, and we can sit here today and predict it. The future will develop. And there are people, a small minority, who see the future better than others and who understand the shape of the probability distribution and whether the expected return compensates for the pitfalls that lurk in the left-hand tail. Those people deserve to do very well. The rest do not.
As to your last question, a lot of people have made a lot of money working in the investment management business without adding much value. Because their efforts have been unsuccessful, but they've been highly paid for it, that's the reason for the passive and index investment movement. And it was just, people were just starting to theorize about it when I was in graduate school. And then in 1974, Vanguard and Jack Bogle invented the first index fund. And now it accounts for a reasonable amount of capital. So yes, over the years, people have invested unsuccessfully and been highly paid for that, which, if you think about it, should not be a formula for success. And so the success for those people, and there are lots of them, is ending. And a lot of money is flowing from active to passive investing. And it's important to realize, not because the results of passive investing are so good, but because the results of active investing are so bad. That's number one. So as a result, I wrote a memo, and I say that about most things, a year ago, last June, entitled Investing Without People. And there are movements like indexation in passive investing and algorithmic investing, systematic, and eventually AI and machine learning, where processes or computers will replace people because at least they won't make the emotional mistakes. And so I think that over time we will see AI coming into use, and a lot of people will be out of work. You may have asked facetiously, but I think it's going to be true. Or at least investing will stop being one of the highest paid jobs in the world for large numbers of people. I still believe that there will be a place for exceptional people, because I think that the computer, as I say in the memo, I don't think a computer can sit down with somebody and figure out whether or not he's Steve Jobs. I don't think that a computer can look at 5 business plans from Silicon Valley and know which one is eBay or Amazon. So I think that exceptional people who can make exceptional judgments will still be helpful to investors, but not clearly everyone. Everyone's opinion on average is worth about average. So I hope that answers it. And by the way, so you can read that memo online at oaktreecapital.com. They're all there, and they're all free, so the price is right, and I hope you will.
When I went to, we didn't talk about this too much at Wharton, but when I went to Chicago, they had done a lot of research which showed that the average mutual fund had done worse than you would have done if you just bought the S&P or the Dow or something like that. So some people started saying radical things like, well, why don't they just buy 1 share of every stock in the index? And there was no word for it in those days, but that turned into what we call passive investing, and it led to the creation of index funds, the first prominent one of which was the Vanguard 500 index fund in 1975, as I recall. So, as I mentioned before, most active managers have not done as well as the index. And by the way, it doesn't stand to reason to think that on average, everybody's going to do average before fees and below average after fees. So it's only the exceptional people who can beat the index after fees. Not everybody, not the average person, but the exceptional. Further, we talked earlier about the emotional challenges of being a contrarian and adding value, and most people aren't in control of their emotions. Most people are, by definition, not contrarian. So there's been a strong movement toward index investing. It used to be something of a novelty back in 1975 or even 85. And today it's a real thing, and lots of people are replacing their active managers with passive, largely because the actives didn't do any good. But as you point out, Jason, in passive, people just buy the same stocks in the index in the same weighting as the index. Now, the irony of this, before I move on to your real question, I just want to point out what I think is a supreme irony of this, which is, why do the stocks in the index
have the weighting in the index that they have. Where do these indices weightings come from? They don't come from up there. They don't come from the operation of nature or physics. This stock has a value of $80 billion. That company has a value of $180 billion. Why? Partially because what the companies accomplish, and partially because of what the investors say they're worth. So the market weightings, the prices and thus the weightings, are assigned by whom? By active investors. And yet there's a trend to passive investment on the premise that the active investors don't really know what they're talking about. And yet, the MO of the passive investor is to emulate the decisions made by the active investors who they think are idiots. So it doesn't make any sense. Anyway, that's what passive is doing today. And we have to wonder about the wisdom of passive investing. And, so one of my clients called up and said that she has a new treasurer, and the new treasurer wants to put all the whole portfolio into an index fund, all the stock. Fire this manager and that manager, not us, we don't manage equities. But put all the money into an index fund. What do I think? What should she say to her treasurer? I said, ask him how he feels about having all his money invested in funds where nobody is thinking about which stocks should be included or what they're worth or how they should be weighted. Anyway, so I think that's a very extreme thing. It used to be that the active managers did all the work of studying companies and figuring out the prices and the weightings and all that stuff. And so if a few people came along and wanted to kind of free ride passively on their efforts, they could just emulate their decisions and not pay the research bill. That was a good strategy. But what happens when most of the people are free riding? Who do they free ride off of? That's the question that I think you'll enjoy thinking about.